Hello friends, this is Raj Sastry from Raj Option Trading. Today is March 4, 2022. Let's take a look at the market. Market is very volatile. Be very careful. And we got geopolitical tensions, Ukraine, Russia, and also Fed is looming. They might increase the rates. And we got an unemployment report coming today. So with that, let's also do a quick deep dive on Twitter and Datadog. So with that, let's jump in. Look from a futures market perspective, we got futures pointing downwards today. Look, Dow Jones Industrial Average down 290 points in the futures market. S&P 500 also down. Nasdaq futures down. Oil seems to be trending higher because of uncertainty, and US Treasuries also down, as you can see here. So with that, Fed has done pretty okay here. Look, Fed is saying there is a high inflation still, and they will carefully begin raising the interest rate in the upcoming March meeting, and they'll be ready to move aggressively if required. And we have a meeting coming up with the Feds on March 15 and 16, and they will do a quarter point rate hike. That's already decided. That's a good story. Market likes that certainty. And we'll start with the one rate hike, and then as we go forward, Fed might think about doing a larger than usual half a point increase. So we have to look here and see, but at least March 15th we have a de-risk here because we know it's going to be a quarter point increase. But we got to watch the Fed language. If they put some aggressive language, then there will be some trouble in the stock market. And Powell also called Russian invasion of Ukraine a game changer that could have unpredictable consequences. So this tells me Powell is open to look at the data and make the decision based on the data. That's always a good story. That way, Powell is more measured than last time back in 2018, where he was overly aggressive. That stock market did not like it. This time, he seemed to be a little more tame and data dependent, which is always good. All right. So with that, let's do a quick deep dive on Twitter. I had a few comments and few questions on Twitter. So let's take a quick look at Twitter. Twitter, as you can see here, we got Twitter here. Stock is at $33, as you can see here. And look, stock is down 3% yesterday, and it's at 52-week low, almost at 52-week low, as you can see here. It went as high as $73, and now it's at $31. That's a huge drop, as you can see here. And if you look at a 5-year chart here, look, it's a 5-year chart. Stock has been it's doing okay, but not too much progress. See here, it's very, very, very low progress. And off late, since 2021, look at the drop here, big drop. So the moment all these Fed rate hike, inflation worries come into surface, that's when Twitter is coming down. So that's what's going on here. Rotation from high growth names. And also Twitter did not have great quarterly earnings report. That's why it came down drastically. And look, from an analyst perspective, we have a hold rating right now. It's just hold rating, as you can see here. And we have 20 analysts who weighed in. So currently it's a hold rating. That's one of the reasons stock is not making too much move. And from a target perspective, folks ask me what the target price for Twitter. The target price is at $59. That's the average target price according to 23 analysts. And look, we got here current price $33.49. To reach the average target price, there is a nice 78% up move from the current price. So that's why it's a beaten down stock. If you can take the pain, also if you can slowly start buying here, there is a good upside, but expect short-term pain here. That's what is going on here. And there is also CEO change. While ago we got a new CEO. Jack Dorsey is focusing more on block at this time, or a square as we call it. And look, from a stock perspective, see what's going on here. We got here, stock is kind of trending down, as you can see here. earnings per share, it went up before, but now it's trending down. That's what's going on here. That's causing some, causing some issues. But off late, looks like earnings per share is improving. That's always a good story. So if they can continue this trajectory and become positive in earning, I can see the stock going higher. From a sales perspective, company doing very good on an annual basis. The sales are growing. That's always a good story. And stocks outstanding is pretty constant, not a big deal. That's all also good. So in a nutshell, company is beaten down here. Earnings per share is improving. That's a good story. If they can turn positive, I can see stock going higher. Sales is growing nicely. That's also a great one here. And analysts are expecting nice progress here. Average stock price is 59. That's a nice 78% upside from the current price. So overall, it's a beaten down stock with high, very good potential. All right, now let's look at a quick snapshot here. Look, Twitter is a $33 stock. It became IPO back in 2013, and it's down 55% from 52-week high. That's a huge big correction. It's hovering around 52-week low, just 7% higher from 52-week low here. Look, we got a target price of 46 here, and we have sales, nice $5 billion sales here. That's a great, nice gross margin. That's good here. Look, net margin is negative. So look, right now net margin is negative. Wall Street does not like negative net margin companies, but I think they can turn a corner here. It's barely negative. If they can turn this to positive, that's a huge impact. And from a next quarter over quarter, the sales growth perspective, this is a growth company. Look, there is a nice sales growth here, whether it's quarter over quarter or year over year or 5 year, it's a good sales growth. That's a good story here. From a valuation perspective, look, it's not too heavily valued, but it's richly valued, but not too much. So it's okay by my books. And from a next year expectation perspective, look, it's got a nice expectation for next year from analysts and even for this year. So that's a nice upside that analysts are predicting for this stock here. Earnings per share is negative. That's one of the reasons Wall Street does not like it. And that's more so with all the inflation worries. These guys have got a lot of cash. Look here, $6 billion cash. You don't need to worry about short-term or even longer-term issues. They can take advantage. And debt is relatively low here. They got a lot of money to take care of short-term obligations. I like quick ratio when it's more than 1. It's nicely 5.9 here. That's a good one. Even current ratio is also good. That's also great here. And they do have some expenses, as you can see here, general administration and selling expenses. And look, they do have some negative free cash flow. Also, Wall Street does not like it at this time here. And as you look through here from a performance perspective, on a short term or even up to 1 year and 2 year, it's negative. And on a 5-year basis, performance is positive. So this stock is getting hammered in the short term here. That's why it's good to slowly start buying. Expect some pain in the short term, but long term this will do well. From a relative strength index perspective, stock is beaten down here, low RSI. It's oversold at this time. IV percentile is relatively okay here, around 40. That's why it's you cannot sell any put options here. It's not rich enough to sell put options. And a lot of people are really buying put options because because IV percentile is low, you get a little bit better price here, and also they are thinking they're hedging their positions and holding some nice put options, so that way if stock drops they can make some money. And look, we got here short ratio. Where is short ratio? Somewhere here we got short ratio. From a short ratio perspective, let's see, where is short ratio? So we'll get to the short ratio in a minute. But look, from an institution perspective, from a Morningstar perspective, they got a C grade in finance, health here, B grade for growth. I think it's a growing company. Profitability D. Altman Z score is 3.4, which is great. And from an industry perspective, they get a grade 4, and grade 4, which is not bad. Grade lower the better, but 4 is okay. And Pietrowski F score is 6. That tells me books are great. You don't need to worry about the books. They're doing pretty good from a book perspective. So with that, I say it's pretty good here. Not a great stock, but if you have a long-term horizon, you could buy this stock and go from there. All right, now let's jump in here and look at quarterly numbers. From a quarterly number perspective, look, it's not a pretty picture. On a quarterly basis, stock has been lagging in the market, down 12% back in the 930 quarter, down 28%, down 23%. I can understand, anybody holding this stock is going through some pain here for last 6 7 months. So it's a little bit painful to hold the stock, but if you can take some short-term pain here, look, it's done something similar back in 2020 and bounced back nicely. I can see same thing happening here also. And from a sales perspective, look, they're surprising Wall Street with nice sales increase here. Revenues increasing. That's always good. From an earnings per share perspective, it's turning positive. That's also good. That's back in 1231 quarter, but now it's negative. And from they got a lot of cash, as you can see here. Cash position is coming down a little bit. I like to see cash going higher, but in this case, cash is coming down slowly. Not a great picture here, but it's not too bad either. And look, from a debt perspective, they're keeping the debt pretty constant and reducing the debt. It's always good when the company reduces their debt. It's always good. It tells you quarter over quarter they're progressing nicely. And debt to equity ratio is it's constant. I like it when it's below 1 or even below 0.5. It's possible. And free cash flow is turning negative, as you can see here. Not a pretty picture. I think they have to improve the situation here. Gross margin, operating margin, net margin, all are improving. That's a great story. They are really focusing on their bottom line and streamlining their operation. That's always great here. Price to sales perspective, it's low at this time here. That's why I think it's a good one to slowly buy, because it's so much beaten down and there is a new management. They're doing a lot of great things to improve the bad news on and fake news. So with that, let's jump in here. Let's see what we can do here. Twitter, what should I do? Look, when they announced they had a good gap EPS on beat, as well as revenues in line, but non-gap they missed by 1 cent. I think Wall Street does not like it, and Twitter shares lose steam because of inflation worries. And Twitter is they want to monetize on the user to double the revenues. They got lofty goals, and they are expanding the fact check. One of the big worries really, Twitter is not doing enough fact check, and they got this bird watch here where they are doing a fact check by crowdsourcing, and this can be a great one here. And they also comply with the EU sanctions on the Russian state media. That's good here. I think stock is beaten down here. It's a long-term good buy, but expect some short-term pain. So thumbs up for Twitter if you can take some short-term pain. All right, next is Datadog. Datadog is one of my favorite stock. Look, stock is down 16% in 1 day yesterday, and it's at the midpoint here from a 52-week perspective, almost at the midpoint. And look, stock is doing okay. Even up here, it's a higher high. So stock is doing well from a 5-year perspective. I think it's a growth stock, as you can see here. And up here, we got nice buy rating from analysts. And we got here 15 analysts covering the stock here and giving a buy rating here. And look, right now, the target price is 202. And there's a nice 36% upside from current price to reach the target price. And as you can see here, this is a growth company. Earnings are going down, as you can see here slowly. I think they should improve this picture. Sales is going nicely. I like this. Sales is going at a very good, healthy clip here. Shares outstanding is pretty constant or slight increase, which is no issue at all as they keep growing. So in a nutshell, if they can stop this EPS going down and sustain and start consolidating and go higher, I can see the stock going higher. But it's a good stock. They've been growing their top line nicely. Look at the top line growth. I like it. It's a nice trajectory for top line growth. So with that, let's look at the quarterly. Let's look at the snapshot here. Look, we got Twitter here. Right now, stock is at 148. Stock is down 25% from 52-week high. It's in correction territory. IPO back in 2019, I mean. And look, it's up from 52-week low very nicely. Nice target price, which is a good upside from current price, which is 148. And from a sales perspective, they got nice $1 billion sales. It's a leader in the data visualization and big data. Nice quarterly growth. It's a growth stock here. Nice year-over-year growth. That's a great story here. Look, net margin is negative right now. That's why Wall Street does not like it. Nice gross margin, softer gross margin. I like it. Earnings per share is negative. If they can turn this to positive, I can see stock going much higher. And from an analyst's perspective, look, earnings for growth, EPS growth this year is negative, but next year is positive and nice and high, and sales growth is also great for next year. So analysts are positive on this company here. From a financial perspective, look, they got a lot of cash, $1.5 billion, and debt is manageable. Quick ratio is 3.9. They can easily meet all their short-term obligations, no issue at all. And from a return perspective, it's a positive cash flow company, as you can see here. From a return perspective, look, in the short term, they're taking some beating here. They're down 12% in 3 months. They're doing much better compared to other growth companies. This company has got a lot of great things going on. They're leader in the data visualization and big data. Look, from a long-term perspective, story is intact. They've done great in 1 year as well as 2 year. Nice returns. And if you look through technical perspective, RSI is 45, tells the stock is beaten down here. IV percentile is high. You could even sell some put options and make some great money, a high IV percentile. And as you look through here, great grade from Morningstar for financial health as well as growth perspective. Profitability is F, mainly because earnings per share is negative and net margin is negative at this point. That's why profitability is F, but they're growing nicely against the industry here. Nice valuation grade, growth grade, as well as profit rank here. Valuation a little bit high. It's a 4, as you can see here, with the PS ratio, price to sales ratio, 44. It's richly valued. That's one of the reasons stock is coming down right now. Piotrowski F score is 5. That tells you the accounting and the books are good here. No need to worry. All right. So with that, let's jump in here and look at quarterly numbers. From a quarterly number perspective, look, it's taking some pain in the short term here. On a quarterly basis, it's down 17% from 1231, as you can see here. But the moment it's down, it always bounces back nicely. Look, we had same thing happening back in 331 with the COVID worries, but stock came back pretty strong. That's why I think it's a good company. If you can take some short-term pain, it's a great one here. From a sales perspective, its top line is growing nicely. Look at the sales here. It's surprising Wall Street all the time with nice sales surprise. Wall Street likes it. Earnings per share perspective, it had a nice surprise when they reported earlier. That's also great. They got a lot of cash. I like the companies when they improve the cash quarter over quarter. This company, as you can see here, since last couple of quarters, it's been increasing its cash, and debt is pretty constant, slightly increased, but it's pretty constant. Debt to equity ratio long term, it's also healthy, no big deal here. And free cash flow is negative. Wall Street does not like this. That's one of the reasons stock came down. And look, gross margin improved, and all the margins are doing okay here. That's not a big deal. I think it's doing okay by the margins here. And look, price to sales ratio is a little bit high here. It's a little pricey from a valuation perspective. So I say overall it's a great company. It's a growth company, as many of you know here. Stock is down 17% on a quarter-over-quarter basis since last 12/31. I think it's a good company to buy for the long haul. They will do great. So with that, what do? Look, we got here Datadog, recently upgraded by both Goldman as well as KeyBank. And KeyBank has a target right now of $210. And they have a nice 541% free cash flow increase. That's always good. And it's one of the monster growth stocks according to Motley Fool here. and looks like it's in a Goldman's conviction list. So a lot of good things going on for this stock here. Stock is beaten down. It's a good long-term buy. I think we'll do very well if you buy Datadog. It's one of the stronger candidates. They can anytime they can turn positive EPS. Stock will even explode higher. So with that, thank you very much. Happy investing and trading. Please subscribe.